Good morning. I'm Tim Nyland, and today we're going to follow up on a subject that I brought up in the most recent asset allocation webinar I did a few weeks ago, and that is the topic of the lost decade in stocks. We're going to take a look at the charts, we're going to define it, and then we're going to do a deep dive into the 6 warning signs you'll want to be aware of when trying to determine if, in fact, history can repeat itself. I hope you enjoy this webinar as much as I have enjoyed preparing it for you. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you'd like to do the kind of analysis you're going to see in this video, then you'll need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Let's go ahead and get started. So I've titled this webinar, "Are we setting up for another lost decade in stocks? A closer look at what history has taught us." And again, this is a follow-up to a webinar that I did on June 23rd when I spoke about why traditional asset allocation the models themselves are more or less breaking down, or in the title of the webinar, doesn't work anymore. And I mentioned this lost decade in stocks, and literally ever since then, for the last month or so, I have been receiving email after email about more information on the topic and more information on equity risk premium. So I've prepared the webinar today, and I hope you enjoy it. From the June 23rd webinar on why traditional asset allocation does not work anymore, recall that we went through the 4 macro factors, right? So total public debt as a percent of GDP, economic growth expectations. We talked about equity risk premium just very, very briefly. And we spoke about yields and the yield curve. And we talked about these 4 macro factors and how they're essentially going to impact all 4 major asset classes, right? So we define those as bonds, stocks, cash, gold, and commodities. And it was beneath that stock asset class discussion that I introduced this topic of the lost decade in stocks. And recall that that period took place between 2000 and 2012. And there were primarily 4 themes that were going on during that 12-year time span. Price return for the S&P 500 at that point was effectively 0 on a point-to-point basis for 12 years. So if you're a Gen Xer or you've been managing money for that long, I know I had just started out in the workforce in the early 90s, and it just seemed that I was never getting any compounding on my money. And that's because of the impact of this lost decade in stocks. It's interesting, too, when you actually lift the hood, like we're going to do here in just a minute, and look at the underlying earnings stream for the S&P 500. While we experienced literally 0% point-to-point price return over those 12 years for the S&P 500, S&P 500 underlying earnings actually more than doubled. And that actually caused a PE F12M multiple compression to take place for that 12-year period. And this all took place while the 10-year Treasury yields dropped from 6.04% to 1.72%. So let's talk about this. Let's look at it in charts. So this is what the lost decade in stocks looked like for the S&P 500. And you can see that I've actually got my little red bar that I like to use to highlight this phenomenon that took place between literally Q2 and Q3 of 2000 all the way to the very end of 2012, which actually notched another QE cycle after the Great Recession. And you can see that on a point-to-point basis, we were just regularly giving up our gains that we had achieved over the prior several years. And the S&P 500 just absolutely went nowhere for almost 12 years. And again, to illustrate in charts, this is what the underlying earnings stream for the S&P 500 looked like adjusted. And you can see that these underlying EPS for the S&P 500 more than doubled. And when you have a price series that is more or less staying flat while the underlying earnings stream itself is doubling, then you get this, what we call a valuation catch-up, okay? And this is that extended 12-year period of PE multiple compression, where the PE multiple itself was being compressed because price was essentially flat and you had this just tremendous underlying earnings growth continuing to drive that multiple lower and lower. Okay, so this is what that PE multiple looks like, and this is what the PE multiple looks like against the back of the 10-year Treasury. So you can see we went from basically a PE, you could call it, I believe in 2000, we probably hit a 25 handle on forward earnings, all the way down to a 13 handle by the end of 2012, off the back of one of the QE cycles from the Great Recession. So again, these are things that we need to keep in mind as we're exploring these charts. Okay, so let's let this sink in for a minute, right? So the period between 2000 and 2012, we had more or less price return for the S&P 500 at 0% for that 12-year time frame. Underlying S&P earnings more than doubled. That caused the PE multiple compression that took place for 12 years. And this is the clincher, right? The 10-year Treasury yields dropped over that period of time from 6.04% to 1.72%. And here's the interesting statement, right? Everyone has been taught the following, right? Declining or low rates are good for stocks and related valuations. Rising rates are bad for stocks and related valuations. And then the question is, how did we go for a 12-year multiple compression and the S&P 500 basically being 0% price return for this 12-year period, while 10-year Treasury yields ended up dropping from 6% to 1.72%, right? What we've been taught all these years is that declining or low rates are good for stocks and related valuations, but that's certainly not what we experienced in the last decade. So the point of this webinar is, obviously I want everybody to see exactly why you need to frame what you've been taught within the proper context. Always challenge these types of assumptions because they don't always turn out to be necessarily true, depending upon the scenario. So exactly what happened during the lost decade, and are we setting up for a repeat of this in the future? That's where we're heading to right now. Before we jump into this deep dive, I did want to take just a quick moment to call your attention to something that I read once a week, and I encourage all you do as well, since especially we're in the middle of earnings season. This is our weekly earnings trend report, and it's available in Advisor Tools. Advisor Tools subscribers have access to this report each week. And if anyone is not a current subscriber watching this webinar, all you need to do is just click on the link in the description below, and we'll go ahead and email you a free copy. So this is just a great way to keep abreast of the latest developments with really detailed analysis of the actual earnings, play-by-play, if you will, each week. Shiraz Mian, our director of research, does a super nice job of going in and slicing and dicing top line versus bottom line beats, sector, even subsector type analysis. And he provides expectations for the up and coming quarter as well as the full year. So just a quick note to be sure to sign up for that if you're not already receiving it, or if you are an Advisor Tools subscriber and you haven't been watching and paying attention to this weekly publication, I would encourage everyone to take a look at it. All right, back to the webinar. Here's a look at again, the lost decade for the S&P 500. And what I want to do now is show you how you can back it up with individual stocks. And the point of this particular series of slides coming up is to emphasize that it's not just technology, right? This happened pretty much across the board in all sectors. So this is Walmart. And what I want everybody to pay attention to, again, is that lost decade time period where you just literally had Walmart sitting flat. I mean, imagine me or anybody else as a Gen Xer coming into the workforce. You just get this great 401k set up. You're putting contributions in, and you're just not getting the benefit of that compounding that you've learned all through business school or whatnot. And you're just wondering what's going on. Meanwhile, earnings are just growing parabolically. And that's what we see here with Walmart. We also see it with Microsoft, right? So right off the back of the dot-com bubble from 2000 all the way to the end of 2013 for Microsoft, you've got the same exact phenomenon. Home Depot, right? So same exact phenomenon. Lost decade. I always like to point out Walgreens as well. Again, I've probably got 30 names I could rattle off the top of my head that this happened, but these are some of the primaries that you've got to know and you've got to pay attention to and look for these trends in the future. This was significant price appreciation and valuation appreciation that took place pre-dot-com. So obviously Walgreens, not a tech name, but obviously still participated in that dot-com run-up. And you can see that distance between the price line and the operating earnings line here in, I shouldn't say operated, it's adjusted, trailing 4 quarters earnings here in orange. The distance between these two lines representing a PE multiple, and that is a massive PE multiple expansion. And you can see over the course of the next 12.5 years, that PE multiple expansion just literally being dwindled away by earnings growth, with price being flatlined. Same thing with a lot of the cyclical names, right? Even a technology cyclical company like Intel, still continuing to grow earnings on a least squares trend basis over those cycles, but the price just not going anywhere, right? So investors just not able to get a bid in terms of a PE multiple expansion. So that's really what we have to look at, right? So to begin to understand this concept of the lost decade, the only way to understand it is to look at the PE F12M series relative to the components of the total equity discount rate. And we're going to make this really, really simple. The key to understanding this phenomenon is to understand why the total equity discount rate here in green stayed flat over this entire time frame, while PE multiples just absolutely collapsed. At the same time, the 10-year Treasury yields more or less collapsed, okay? And the answer lies in this concept, again, of equity risk premium. And this is super important to understand. I know we've talked about this in the past. We're going to do a little deeper dive on it now. Note that as that 10-year Treasury yield collapsed over this 12 years from literally 6.04% to, I believe, this 1231 point is right around 1.72. That's a huge collapse in yield. At the same time that was taking place, the premium that investors required just to maintain exposure to the equity asset class was rising at that same time, right? And it increased such that it more or less offset the decline in the 10-year Treasury. And we can see that because this total equity discount rate, where this green line is shown as flat from 2000 to the end of 2012, is basically the sum of the 10-year Treasury plus equity risk premium. So if you can imagine, right, from a fund flows perspective, if we want to look at equity risk premium this way, you could say, well, this dot-com and this 9/11 event really triggered this risk-off trade where perhaps flows were flowing out of the equity basket of securities, causing equity risk premium to rise. At the same time, the investors were deploying that same capital into the risk-free basket of securities in the form of the 10-year Treasury, driving down those yields. And it was more or less a 1-for-1 because the total equity discount rate stayed flat. Remember, 10-year Treasury, or the risk-free rate, plus some premium to be in equities gives you the total equity discount rate. And again, this is the rate that's used by most Wall Street models out there to do all of the discounted cash flow analysis to arrive at present value of equity securities. So this is a big concept. Recall that from prior webinars, Treasury yields do not explain PE multiple expansion and contraction over time, specifically attributable to macroeconomic headline risk. When you listen to CNBC and you read the Wall Street Journal, all you see are people and pundits and professionals trying to relate interest rates to PE multiples, and they simply do not have any statistical explanatory power. And we're going to show you that in just a few minutes, but you can see it right here on this equity risk premium chart. When you look at this PE F12M, it's V-shaped from 2000 to 2021. We go from record highs in 2000 to record lows in 08 to 11, and then pop back up to record highs in 2020. Meanwhile, Treasury yields have just gone straight down, and at a time when we had record high PE multiples for the S&P 500 in 2001, we had Treasury yields at 6%, and now we've got those same elevated PE ratios at 21 times, and we're sitting at record low 10-year Treasury yields. So how do we explain this, right? And again, it comes back to equity risk premium. So equity risk premium explains that portion of a PE multiple contraction or expansion over time attributable to macroeconomic headline risk, right? It's not the 10-year Treasury. Look at the correlation in these two series, V shape. It's almost perfectly inverted, inverse correlation. Okay, and you can see that we had record high PE with record low equity risk premium, right? As investors bid up that PE valuation, equity risk premium drops. You can see that here as well. Okay, same thing. So super important. So let's prove it, right? Let's run a regression and let's look for the statistical proof. So the S&P 500 PE F12M versus the 10-year Treasury yield. And I don't care how you do this. You can look at it from a PE perspective. You can look at it from a one-year change perspective. You can look at one-year change on a 10-year Treasury yield. You can look at S&P 500 price relative to the 10-year Treasury. You can transform both of those to 1-year percent change. You're just not going to find any statistical significance. And you can see on the chart what a regression would look like. And if you actually click on this beta coefficients button out of interactive charting in the research system, you will actually be able to run that regression, and you'll see that the 10-year Treasury yield explains roughly 1% of the movement in the S&P 500, and it's correlated at 0.09. Right? There's just no statistical significance at all. However, when you run a regression of PE F12M for the S&P 500 versus the equity risk premium, you get something very different, and you can actually see the power of the inverse correlation on the chart. And when you click on this beta coefficients button right here, you get the regression itself, and you can see that equity risk premium is actually able to explain 73% of the movement in the underlying S&P 500 PE F12M, and it's actually correlated at negative 0.85. Right, so this is statistical significance, and that's what it looks like. So how exactly do you describe what happened during the lost decade? So let's add a little bit more color to this picture, right? So the very first thing that happened is we had this shift in investor appetite for risk, right? And this happened off the back of the dot-com implosion and 9/11. Investors maintained a risk-off appetite and were literally selling stocks, which was in turn driving up equity risk premium, and they were piling into treasuries, and that was driving down the 10-year Treasury yield. What also happened was we had this risk shift sentiment. The magnitude of it was very large, something that we haven't seen since. And it was almost a 1-for-1, and we know that because the total equity discount rate literally remained constant for 12 years. So this took place obviously from 2000 to 2012 again, and the premium that investors required to just be in equities, and that's how we measure that equity risk premium, increased such that total equity discount rate again remained flat. So a very, very large magnitude of risk sentiment shift during that time frame. The other thing that happened, this point number 3 is super, super important because there's a lot that goes into the calculation of equity risk premium, is to understand that from an equity valuation perspective, right, that increase in equity risk premium that we saw from 2000 to 2012 was able to literally absorb all of the valuation benefits of the underlying earnings growth over this time period. So what was happening was equity prices were stagnated, right? We saw the charts as money was flowing from the equity basket of securities into the risk-free basket of securities. We saw that over that period of 12 years, that PE F12M valuation compression was the ultimate result of those flat prices against that tremendous underlying earnings growth. On average, again, remember when we looked at the S&P 500 composite, those earnings had grown greater than 2x from 2000 to 2012, again, for that S&P 500. So not even that tremendous amount of earnings growth was able to offset the amount of premium that the equity risk premium itself was absorbing in terms of valuation from that underlying growth series. So that was tremendous, and that's important to understand. So where do we stand today, and is the stage being set for a repeat? It's possible, right? It's definitely too early to tell, but there are 6 warning signs that we need to pay attention to, and I'm going to go through all 6 right now. The very first warning I have here, warning sign number 1. You only can really appreciate this when you look at this chart and you look at price action of the S&P 500 during recessions, and you pretty much have to do a double take on our price response to COVID during a complete U.S. economic shutdown. The S&P 500 absolutely just exploded. And obviously, it's due to the amount of stimulus in our response to COVID. But we're talking about an S&P 500 price that's literally increased. I just say it's roughly 25%. I ran the charts. It just depends upon the start date you use and when the official COVID date is. But the important point here is not the 25%. It's to look at the chart and realize that other recessions where, recovery was literally measured in years. I mean, if you look at, 2000, it took us all the way back to, 06 to get through the dot-com bust in 9/11. And it was the same thing for the Great Recession. You're talking about a 5 to 6 year recovery. And you look at this chart and you go, where was the recession, right? Well, we can see it happened in earnings, but the price response certainly wasn't there. It was there initially, but you can see where this is going. Where we're going with this, obviously, is this tremendous valuation expansion. And we had that same phenomenon here. This is obviously the start of the lost decade. Okay. So warning sign number 2 is, again, that COVID recession rally in equities has driven PE F12M multiples back to levels where the stage was set last time for the lost decade. You can see that right here. Okay. Warning sign number 3 is that this COVID recession risk-on rally in equities has driven equity risk premium back to levels where the stage was set last time. So you can see, I calculate this each week, and when COVID struck, I was in awe at the rapid increase in equity risk premium here. And then as I continued to calculate the series each week, obviously that quickly abated, and here we are now at record lows again. And these are low levels back to where the stage was set last time for this lost decade in equities. And you can see the magnitude of that rise in equity risk premium that took place from 2000 to 2012. It literally offset the decline in the 10-year Treasury. And you can see that the premium that investors began requiring over that time frame was just enormous relative to its history. And that's the important point about equity risk premium. We're able to quantify that in terms of percent. Warning sign number 4, price relative to earnings action on S&P 500 is very similar, right? When considering the same levels of PE F12M now versus pre-lost decade. And I have pre-lost decade highlighted here, this period between 98 and 2000. What you're looking at is this multiple expansion visually. So the distance between the blue line and the orange line growing, right? You can see these are very close here, and we get this multiple expansion up until the point where the lost decade begins. And we've got a similar scenario playing out here. We've got 2 question marks out here because we just don't know, right? What happens if this earnings recovery doesn't materialize? What happens if we get a 4th or 5th wave where we don't have a vaccine and this rolls over, right? We have the possibility for a debt event, let's say, right? We've got public debt to GDP at record highs, and if this growth doesn't materialize, how do we pay our debt? I mean, there's a lot of scenarios that can play out here. We just don't know. This is just stuff that we need to be aware of, and we have to appreciate what the history here is trying to show us. We need to acknowledge it. So warning sign number 5 is to look at some of these bellwether names and acknowledge the fact that we've got similar price and earnings action taking place here as well. And I just bring one up. We're not going to go through all of them, but Microsoft, same exact thing. PE multiple expansion, just massive, right? Then you get this lost decade. Well, we're getting that same multiple expansion now. This is obviously for different reasons. Microsoft's a totally different company now, but we don't know what's going to happen here, okay? Warning sign number 6, and this is obviously the piece we're missing. What are the catalysts to drive equity risk premium levels higher over the longer term? So do me a favor and ask yourselves these questions while we're sitting at record lows, right? What is the path of least resistance from our current record low levels of equity risk premium? Are we going to flatline here, or are we actually headed back to median trend at some point? I think it's pretty safe to assume that at some point in the future, we're probably going to revert back to that 20-year median. It seems like we always do in looking at the charts, and I don't think that's an unfair assumption. So what we need to do is we need to take a look at what happens to equity valuations when equity risk premium reverts to 5.11%. We've already looked at the statistical relationship of PE multiple expansion and contraction, and overall for the S&P 500, we know that the S&P 500 PE F12M, 73% of the variable in that forward multiple can be explained by movement in the underlying equity risk premium. So if this thing goes from 3.18, where we're at right now, to 5.11, we know that a large portion of that PE multiple that we currently have for Microsoft is going to contract. So what we need to think about is what happens to equity valuations if, say, over the next 5 to 10 years, this equity risk premium reverts back to 5.11. We know that PE multiple is going to contract, but by how much? So these are some of the things that we're going to look at next week. So be sure to join me next week while we continue this discussion. Next week, we're going to take a look at what it would take to drive equity risk premiums higher long term. We're also going to utilize the Zacks valuation model out of the research system to illustrate and quantify the impact of equity valuations, assuming that equity risk premium reverts to its 5.11 20-year median longer term. So we're actually going to model that, and I'm going to do it for Microsoft. We'll do it live next week. So you're not going to want to miss out on that follow-up discussion. Thank you all for attending. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you for watching, and I'll talk to you all next week.